Let's face it, there's more investment funds to choose from than there are different packs of crisps down a supermarket aisle. Some come in cans, some come in massive packets, some come with a little sachet inside the pack of crisps, and some are shaped like bears and even monsters. And if you shop at Aldi like me, some look like name brand, but taste just as good. Money saving tip there for you. Knowing what funds to pick is a daunting experience. I've been there when I started investing. In fact, some of the first funds I invested in were ones that were just recommended to me. I didn't even really look into them. I just thought, oh, they sound okay. Since starting investing though, of course, as I've gone through the years, I've learned a lot more about how to dissect different funds and understand about how to look into some of the little minor details which add up over the years and can end up costing you a lot of money. I've developed a bit of an informal checklist, which I'm going to call my 10 steps process, which sounds better than just saying, here's how I pick my funds. So in this video, I'm going to run through my 10-step process, walk you through each of them with some examples and as many examples as I can throw in. So hopefully by the end, you've either learned loads or you've realized that I have no idea what I'm doing, and you can let me know in the comment section below. So without further ado, let's put the fun back in these funds and let's get started in point number 1. So this one's all about you, and this one's going to be completely personal. You need to work out what you're looking for in a fund and why you're investing in the first place. So go back to your original goals. Are you an income investor? Are you someone who's long-term and just purely looking for growth? Are you happy to speculate? Have you got maybe a higher risk profile than the average person? Or are you looking for something more passive? Figure this one out first, because there's no point going any further unless you really understand what you want to get out of your investments. Otherwise, we're just looking at numbers on a sheet which mean completely nothing to you, when really it's all about what you want to achieve and what outcomes you're trying to achieve when you come to investing. So this one is personal. Please do seek out help if you need it. I'm not a professional financial advisor, so do all of your own research and seek that help out if you do. But with that bit said, now let's get into some of the juicy numbers and head over to step 2. Arguably, this one alone I could speak about for hours, and is probably one of the most important things we need to look at and consider all of the different costs and fees associated with not only just investing itself, but looking at the ongoing costs associated with investing into different kinds of funds. Trust me when I say that these can add up over the years and they will end up eating into your investment pot, especially over the long term, in the tens, maybe even the hundreds of thousands of pounds. So just pay attention to this one. Remember that fees will sometimes be one-off costs, maybe to get you into a fund. Some will then be recurring costs, which might happen monthly, could even be drawn quarterly as well. And then some may even be fixed costs, which might come out each month, regardless of how much you've got invested. So pay attention to the small print in this section. I'll run through a real world example in just a moment, but one of the biggest things to say is really, where possible, try and reduce your fees, because although it sounds like very small numbers, any reduction in fees that you can get in your investments is more money which can compound and snowball, especially if you're a long-term investor, and that will have a real world impact on what you end up having, and maybe even retiring a few years early. So to show you what this looks like in practice, I'm just going to pull up one of my favorite funds on the Hargreaves Lansdown platform. Of course, you can do this on any platform you like. So if we start from the top in this example, we'll see that there's no entry fees or charges to invest. So big tick in the box here. I mean, to be honest, I've not seen any funds, at least that I've invested in, that have charged me to enter them. You'll really see this being a lot more common if you were investing into a hedge fund. But in that example, you probably need hundreds of thousands or millions of pounds to invest. Secondly, here, we're going to look at the ongoing cost ratio. So sometimes you'll see this abbreviated as OCR or even TER, which stands for the total expense ratio. And this is probably the bit which is going to add up over time, and is the bit which is going to recur annually to you, depending on the fund you're invested in. So in this example, you can see that the ongoing cost is 0.31%. So cheap or expensive is a purely subjective thing. It's certainly lower than it has been compared to lots of other funds out there, but this is an absolutely key number we need to look at. One little sneaky cost, which is not always easy to find, is transaction costs. So for whatever reason, it's not included in the OCR figure. So you'll find it in the cost section on Hargreaves Lansdown page, where it gives you an example of what a £5,000 investment might look like in charges. So we can see here in this total, it's actually 0.83%. This leads me on to the final charge you need to think about, and that's the platform fees. So these are going to be separate from the fund costs and the ongoing charges of the fund. These are fully dependent on the broker that you use, but you can't escape this one. So in this example on Hargreaves Lansdown, their ongoing charge is a 0.45% account fee up to £250,000, and then there is a tiering from there. But every platform will have its own charges. Some may even charge monthly, but a lot of them will charge depending on how much you've got in that account. So on the third point, I don't necessarily pay too much attention to the size of the fund, but it is something worth glancing over just to make sure that you're in the right place. So for example, if you find a fund which maybe only has a few £1,000,000 in it compared to hundreds of millions, you may think that you're looking at an investment which is probably only interesting a small number of investors, and then this potentially could lead you to think either this investment hasn't been doing too well, or it may not be one for you, especially if your risk profile isn't suited to that kind of investing. So it's not something I'd necessarily give a heavy weight to, but it is worth just checking how much money's in this fund, because it could also affect how easy it is to transact in and sell out of a fund. Now let's look at performance, and this is always quite an interesting one because there's a famous saying in investing that the past performance of something is not a reliable indicator to what might happen in the future. However, I don't think this really tells us the whole truth. In my personal opinion, it would be completely wrong to discount what has happened in the past to at least not give us some kind of indicator to what might happen in the future, especially if it's occurred over a long period of time. Let me give you a couple of examples. If you were to make a bet on who would win a golf match, whether that would be Tiger Woods or a random amateur that you just picked from a golf club, I think I know who you'd put your money on. And why would you do that? Well, Tiger Woods is a proven professional who's won many international majors competitions, and you know that he can deliver under pressure. Whereas of course, if you have someone you've just picked from a random pool and you have no idea what they're doing, I think you'd rather pick someone with a proven record. Likewise, if in the same example, if you were to put me up against Lewis Hamilton in a Formula 1 car, I think you'd much rather pick Lewis Hamilton's record of Formula 1 racing than mine, because I don't have one. So although past performance is not necessarily a reliable indicator for what can happen in the future, I would certainly rather go with a fund, for example, which has averaged 5% every single year for the past 20 years than one which has been up and down all over the place. It would be certainly something that I would give a heavy weighting to. It shouldn't steer your entire decision-making process. Otherwise, you might end up with funds which have performed really, really well over the last few years, but may well perform badly in the future. That's always very possible. For a useful tip here, if you are looking at performance, you need to compare it against something. If you're going to be looking at these actively managed funds, compare it on a graph against the S&P 500 or a similar market to see if it actually has achieved its goals and is beating the market. Because if it isn't, we may as well stick with the passively managed fund. And then secondly, if it hasn't beaten the market now, what are the prospects of it beating the market in the future? Has something fundamental changed about maybe the sector that you're looking to invest in? But just bear that in mind. So this one's an interesting point because we do need to consider how long a fund has been around for, just for a couple of number of reasons. So typically what happens in this industry is that poorly performing funds tend to get liquidated or merged with another fund. And if we see a fund which has maybe only been around for a year or so, and we see that it might have performed well last year, but we can't go back any further, then we're limited to what information we can base our decisions on. Longer established funds don't necessarily mean that they're going to perform better in the future, but of course we can look back and see if they've established themselves well in the market. Typically, if a fund's been around for a very long time, then it's probably had some pretty good performance, otherwise the fund managers would have closed it. No one wants to see a fund with minus 20% consistently in their books. So again, not necessarily one you're going to give a huge amount of weight to, but one being aware of and one that you should be skeptical of looking at a brand new fund, for example. This one should be quite straightforward, and again, it's all going to come back really to your personal position and what you're really looking for in your investment. Often investment funds will come in two different flavors, typically with the same charges and the same holdings. It really is all about whether they accumulate or they pay out dividends. So very simply, a dividend paying fund will be one that will pay out its dividend in cash for you during those set periods of time. Some funds may be monthly, biannually, check that in the sheet. Whereas an accumulation fund, rather than paying you out that dividend, will roll that and reinvest that into the fund, which will be better for long-term growth, meaning you don't have to deal with that cash when it comes into your account and you haven't got to be concerned with reinvesting it manually. There's no better or worse option here. This really all comes down to your personal preferences, and it may also affect your personal tax position too. So if this is something that you're interested in or something you're maybe concerned if it's going to affect your tax position, again, seek some help from an expert, because that is certainly not me. Personally, I'm always going to choose the accumulation option if I can, because really I'm looking for long-term growth as an investor and I don't really want any income. Although I do have some dividend paying stocks, I'm taking that money where I can and reinvesting it back into the market. This one's an interesting one, not necessarily one I would put too much weight on, but there are funds out there who are hedged. In the essence, they're looking to reduce that currency risk and your currency exposure, especially if you're investing in stocks from other countries. Personally, in this new globally connected world, it's almost impossible to reduce your currency risk down to zero. If you just think about your local market, for example, in the FTSE 100, the majority of companies actually derive a lot of their income, in fact around 70% of their income, from currencies outside of the UK. Think of the big oil giants and the big pharmaceutical companies. They take a lot of their income in US dollars, in euros, for example. So whether you like it or not, you are exposed to different currencies on a daily basis. So in my opinion, if you are a longer term investor, this is not something that personally concerns me, and ultimately over a longer period of time will kind of level out. Whereas if you're a shorter term investor, this is something that you might want to look at. Overall though, if you have a well diversified portfolio in multiple different asset classes, in multiple different countries, then really you cancel out the currency exchange and you shouldn't be concerned really with what happens. Hey, you can even buy some cryptocurrency too. Bitcoin's doing pretty well at the moment. So this is another one of those interesting little details that a lot of people might skip, finding out where a fund is domiciled. This is totally different from what it invests in, and you'll often see as a UK investor, really what you're looking at is for a fund to be based here, either in the UK itself or in somewhere like Dublin. If it's based somewhere like Luxembourg or outside of this, you may end up being liable and end up having to reduce some of the dividends you're paid, especially when you're investing in US companies. So as you may already know, there is a withholding tax from US companies that pay you dividends here in the UK. For example, if you were owning a stock, you may end up costing yourself 30% of that dividend being withheld before it's paid out to you. Unless, of course, you're in a situation where there is a treaty like there is between the UK and the US, where you'll only end up paying a 15% dividend withholding tax rather than a 30%. So just be aware of that. If you can, you're going to prefer those Dublin-based domiciled funds. Again, though, if you are going to be worried about your own financial position, your own tax position, this is something you will need to consult a professional on. That is certainly not me, especially if you're talking much larger sums of money. Now we're getting into some of the more juicy things, and this really is less about the numbers and more about kind of qualitative thinking and fundamentals of a business and what we think the future might hold. So if you go to the section of the fund which talks about what the fund is holding and what companies they're invested in and what different assets they're invested in, ask yourself the question, do those match up with what the fund is trying to achieve? For example, often funds, especially managed funds, will say they want to beat the S&P 500 by at least 1% or 1.5% per year. Do you think the basket of stocks and how they've weighted them will beat the S&P 500, for example, over that period of time? For example, you've got funds looking at electric vehicles, you've got companies looking at clean energy, for example. Do they match up with the companies in that basket? Have they got the leading ones? Do you think they're going to turn a profit? Are they currently companies that are well established, or where are they newer? And are they more of a speculative investment, or are they a safer investment? If this is a speculative investment, that's not a problem at all, but just remember you need to take that back to your individual risk profile and your individual goals. If a lot of these companies aren't going to make a profit for the next 5 years, but you're hoping to retire in that time, maybe give it a double take and just remember what you're investing for, because ultimately nothing is certain and nothing is fixed in the future. And on the flip side, let's say if you're not necessarily worried about growth, but you're more interested in income, look at the income producing companies on that dividend list of the fund. Are they ones which have been paying their dividend reliably? Are they ones which you think can sustain that in the future? And just give your brain a bit of a rack and consider some of the top holdings if you think they're going to be companies which are able to pay their dividends into the future. Even if their yields might be high now, do you think this is going to sustain you? If you go back to point one, think about why you're investing. You don't necessarily have to go into each company in really high level detail, but it's good to understand some of the high level information on those companies, what industry they're invested in and what the current market conditions are. The more information you can use as an investor, the better. Bear in mind though that dreaded statistic that everyone seems to knock out, that ultimately those actively managed funds, especially in the large cap sector, underperform their passively managed cousins 90% of their time over long periods of time. So you really are trying to find those little golden nuggets, maybe in the smaller cap stocks or in the niche areas which you think you can beat the market. So final point here, and again this might be more self-explanatory, but there are two kinds of funds, those who are actively managed and those who are passively managed. Actively managed funds will have fund managers, analysts, teams, big and small, looking to achieve the goals set out in the fund sheet. Whether those are outgrowing the market by 1.5%, whether that's giving you a consistent dividend payment month after month, matching those things up with what they're trying to achieve, and they'll be charging you handsomely, no doubt, for those goals and for those achieved aims. As you can imagine, active fund management of any kind is going to add up and of course will always be more expensive than a passively managed index fund. As I mentioned earlier, if you do want one of the absolute golden nuggets of investing, it is that those passively managed index funds who track major indexes do tend to outperform their actively managed cousins. And that is just a fact. So just be very wary of that one when you are investing and understand those risks. So personally for me, I've got investments all over the place, but definitely a core of my own strategy is having those low cost passive index funds sat there in the middle. And then outside of that, having smaller pots of cash, both in some dividend stocks, some more interesting growth stocks, a bit of company equity, and then of course in cryptocurrency too. I will eventually get round to doing my full investment portfolio so you can all enjoy and poke fun at it. But for now, I hope you've enjoyed the video. Drop me a big like if you have found it useful and subscribe for many more. And as always, happy investing.